Hello and welcome to AI Market News by LM. You know, there's a major split opening up right now in global economic policy. It's like the world's top central banks are all looking at the same map, but deciding to take completely different roads. One is hitting the brakes, another is hitting the gas, and this divergence is creating some serious waves in the markets.
So here's what we're going to break down. We'll kick things off with the US Federal Reserve's big, surprising move to cut rates. Then, we'll zoom out and see just how different that is from what's happening elsewhere. After that, we'll dig into how the markets are reacting, look at the absolutely critical week coming up, and then wrap it all up with the key takeaways.
Okay, let's get right into the biggest story moving the markets. The US Federal Reserve just decided to lower its main interest rate. And this wasn't just a minor tweak. It signals a huge shift in how they're thinking about the economy. And really, this quote from Fed Chair Jerome Powell says it all. When he says the balance of risks has shifted, that's code for a major change in priorities. For months, it's been all about inflation, inflation, inflation. Now, the Fed is explicitly telling us their main worry has shifted to protecting the job market from downside risks.
And here's the result of that thinking: a quarter-point cut. The new federal funds rate is now sitting in a range of 3.5 to 3.75%. And this is actually the third cut we've seen in the last 3 meetings, so there's a clear pattern of easing here.
So the big question is, why now? Well, Chair Powell laid out 3 main reasons. First, he said the job market is gradually cooling. Second, and this is the big one, those downside risks to employment are growing. And finally, they believe any inflation we're seeing from tariffs is just a temporary blip. It all points to one thing: the Fed is now playing defense for the job market.
But here's where the story gets really interesting. Let's zoom out, because the Fed's move isn't kicking off some big global trend. In fact, it looks like they're going it alone, creating what a lot of people are calling a great divergence.
And this comparison between the US and Australia just paints the picture perfectly. While the Fed is cutting rates because it's worried about jobs, the Reserve Bank of Australia is holding rates steady. Their governor, Michelle Bullock, basically said a rate cut wasn't even on the table for them because they're still worried inflation could pop back up. So we've got 2 major economies on completely different tracks.
Now, this isn't just some academic debate, right? This has real-world consequences. When one huge central bank is easing policy, while others are holding tight or even thinking of hiking, it creates a ton of tension. We're seeing it play out in the volatility of currency pairs like the euro-dollar and across global bond markets as investors just scramble to figure out what all this means.
And just to throw another wrench in the works, we got data showing Japan's economy actually shrank last quarter. The Cabinet Office reported that real GDP fell by 0.6%. So while the US is worried about jobs and Australia is worried about inflation, other parts of the world are dealing with actual economic contraction. It's a messy picture out there.
So, with all this conflicting news, how did the markets actually take it? I mean, a rate cut is supposed to be good for stocks, right? Well, it turns out the reason for the cut matters a whole lot more. And you can see that right here. Even with the rate cut, US stocks took a pretty big hit. The S&P 500 fell over 1%, and the tech-heavy NASDAQ dropped even more. This reaction tells us that the market is more spooked by the weakening economy that forced the Fed's hand than it is excited about cheaper borrowing costs. Now, if we look at where the big institutional money is going, things get even more telling. The latest CFTC data shows that large speculators are net short the S&P 500, meaning they're betting on stocks going down. But at the same time, they're heavily long the euro and the Japanese yen. What does that tell us? It suggests they're betting on a weaker US dollar as the Fed keeps cutting rates while other central banks stay put.
Okay, but this story is far from finished. In fact, this coming week might be one of the most important of the entire year for figuring out where this global divergence is headed.
According to the economic calendar on investing.com, next week is just jammed-packed. On December 18th, we get a huge inflation report from the US, the CPI data. That same day, we hear from both the European Central Bank and the Bank of England on interest rates. And then, a day later, the Bank of Japan makes its call. These events are either going to cement this whole divergence theme or throw a massive new twist into the story.
All right, let's pull all this together and nail down the key things we need to remember.
So number 1, the Fed has flipped. Their priority is now protecting jobs, not just fighting inflation. Number 2, this puts them at odds with other major central banks that are still laser-focused on prices. Number 3, this great divergence is the main reason we're seeing so much choppiness in the markets, especially in currencies.
And finally, all eyes are on next week. It's going to be huge.
And that kind of leaves us with the big final question, doesn't it? With all these central banks taking such different paths to deal with their own unique problems, whose strategy is actually going to work? Will the Fed's focus on jobs save the day, or will the central banks fighting inflation have the last laugh? The next year is going to be absolutely fascinating to watch. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.